This video is a history of banking crises in the United States during the 20th century. It was presented at the Association of Private Enterprise Education meeting on April 9th, 2024 in Las Vegas, Nevada. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I worked on this project with my wife, Catlin Cundiff. In this presentation, we study bank failures during the last 100 years. We analyze their causes and discuss how monetary and regulatory policy contributed to them. We also look at bank failures during the Great Depression of the 30s, the Savings and Loan Fiasco of the 1980s and 90s, and the bursting of the housing bubble during 2007 and 2008. We will propose some regulatory and monetary policy changes that could lead to a more stable banking system. There have been many economic crises in U.S. history. Going backwards in chronological order, we can consider the housing crisis of 2007 and 8, the bursting of the dot-com bubble from 2000 to 2003, the savings and loan fiasco of the 80s and 90s, Nixon defaulting on the international gold standard Bretton Woods in 1971, FDR defaulting on the domestic gold standard in 1933, the Great Depression and the stock market crash, which went from 1929 to 1933, and the excuse for creating the Federal Reserve, which is the Panic of 1907. In this video, we're particularly concentrating on crises that led to bank failures. So the three that are emboldened, the housing crisis, the savings and loan fiasco, and the stock market crash in the Great Depression, are the ones we will look at in some detail. If we look at this graph, we see the numerical number of banking failures as a function of year from 34 to close to today. If we extend it out to today, it doesn't make a whole lot of difference. There haven't been a lot of banking failures, even though some started last year. So we see a cluster of banking failures during the Great Depression back here in the 30s, another huge cluster during the 80s and beginning of the 90s and the savings and loan fiasco, and yet another cluster here around 2009 due to the housing crises. So why did all of these bank failures occur? Well, if we go back to the Great Depression, there wasn't a Glass-Steagall rule that split up commercial banks from investment banks. That was passed in the United States after this. So if you made a deposit in the local bank could take your money and invest it in the stock market. When the stock market crashed from 29 to 33, the banks lost a lot of money, including money that belonged to depositors, and therefore went bankrupt. The passage of the Glass-Steagall Act after that probably helped in the United States. This was not done internationally, and it may have had some negative consequences. One of them would be in Europe now you have banks owning companies, and they probably prevent CEOs from making nearly as much money as they do in the United States, which has diverse stock ownership and therefore not as much oversight of companies. The next set of banking crises here is the savings and loan fiasco. That was caused by duration mismatch and is similar to what happened in Silicon Valley Bank in this past year. Under a duration mismatch problem, if interest rates go up, bond prices go down, and housing loans look a lot like bonds. So to the point of view of the bank, as interest rates went up, the value of home mortgages dropped drastically, and that wiped out the equity that they had. The final crises here, the housing crisis, was also related to home mortgages, but in this case, they were mainly variable rate loans, whereas during the savings and loan fiasco, they were primary fixed rate loans. So as interest rates went up on the variable rate loans, the individuals who had borrowed the money, sometimes at 0 equity down were not able to make their payments, and they defaulted on their loans, and this spread through the banks and caused the banks to go bankrupt. And we will look at least the last two of these in somewhat more detail. We can see here what happened again during the Great Depression. It's well known that there was this huge drop in the value of the stock market. Those from the Austrian economics perspective would say that government money printing in the 20s caused a bubble, and then cutting down on that printing in the late 20s caused the stock market to start dropping. Since at this point in time, margin requirements were maybe only 10% down. If you had a 10% drop in the stock market, it would cause people to get margin calls, be forced to sell their stock. The stock would drop even more, causing more margin calls, and basically you had a huge wipeout in the stock market from 29 to 33. And again, banks at this point in time would just take depositors' money, stick it in stocks, so the banks were wiped out as well. This graph shows the general price level in the United States from 1800 to around 2000. The slope of this graph, or the derivative of this graph, is what we would call inflation. You can see that there was very little inflation throughout most of U.S. history until post-World War II, and in particular post-1971, when the U.S. defaulted on the international gold standard known as Bretton Woods. At the beginning of the United States, one of the major arguments was whether or not we should have a central bank. Thomas Jefferson was against having a central bank. Alexander Hamilton was for. When George Washington was president, he sided with Alexander Hamilton, since Hamilton had been one of his aides during the Revolutionary War. Therefore, we got the First National Bank, which you can still tour in Philadelphia today. The First National Bank was opposed by Jefferson and Madison, who let its charter expire when he was president. But soon after that, the War of 1812 began, and the White House was burned, and Madison decided it might not be a bad idea to have a central bank to pay soldiers. Therefore, he created the Second National Bank. And you can see this bump here that is small by today's standards of inflation due to the operations of that bank. That bank came up for renewal of its charter again under Andrew Jackson. Andrew Jackson hated the idea of central banking, basically went to war in a sense with Nicholas Biddle, the head of the bank. Bickle said he would destroy the U.S. economy, blame it on Jackson, try and get him voted out of office. Biddle failed, Jackson succeeded, and got rid of the Second National Bank, and we had no central bank from the time period of Andrew Jackson until the creation of the Fed in 1913. And you can see, with the exception of the Civil War, when Lincoln printed greenbacks to fund it, we basically had no inflation during that time period. The Federal Reserve was created under Woodrow Wilson in 1913 and did what all central banks do. It printed a lot of money, probably resulting in the bubble in the stock market in the 1920s. And when they cut down on the money printing, then that bubble burst. And then post that time period, during World War II, there really was no, set rules as far as monetary policy. After World War II, the Bretton Woods Agreement was signed internationally, which did not allow for a domestic gold standard, but allowed for an international gold standard. During the time period of FDR, he outlawed gold domestically, seized all of the gold from the nation's banking system and put it in Fort Knox. Individuals were allowed to hold up to around 5 ounces of gold, but this was also discouraged. And then later on in here, in 71, Nixon defaulted on that international gold standard, Bretton Woods, and since then we've been on a complete fiat money printing system, resulting in very massive inflation. This is FDR's executive order outlawing gold on or before May 1, 1933. All gold coin, gold bullion, and gold certificates now owned by them must be given to a Federal Reserve Bank. So today we have Keynesian economic theories, monetarist theories, all these different ideas of how central banking is supposed to control the economy, and the question is valid: does government policy cause or prevent economic crises? The Keynesians would believe that you could have stimulus packages that would sort of counteract the animal passions of individuals and more stabilize the economy, whereas the Austrians, Ludwig Mises, Frederick Hayek, as opposed to John Maynard Keynes, believe that government operations were more likely to cause economic crises than prevent them. Monetarists look at things like the Fed funds rate and the quantitative easing. One of the biggest differences between the Austrian and the monetarist school. If you talk about something like the Great Depression, the Austrians would blame it on money printing during the 20s, causing the bubble in the first place, whereas the monetarist would think the problem was after the bubble burst, there wasn't enough money printing. And then the Keynesians would agree with the necessity for money printing during those time periods, and they would also say you should have deficit spending. And of course, politicians love the deficit spending part. The Keynesians would also say during good economic times and inflation, you could cut down on government spending, which they weren't big fans of. So here is one of the primary money tools of the central bank, the Fed funds rate. It was the primary tool until the modern era of quantitative easing. If we look in recent terms, we can see this recent relatively large increase in the Fed funds rate just in the last few years as a response of inflation in the economy. During this time period, again, we had a run-up that was stopped during the time period of COVID, and of course the money printing during COVID is what's causing all the inflation that we are having now. If we go back a little bit further, this is the era of the housing crisis. What caused the housing crisis, as we'll discuss in further detail, is we had this long period here of very low interest rates. At that point in time, you had variable rate mortgages largely in the system. People borrowed at 1 or 2%. Interest rates go up to 5%. Their home mortgages could have doubled, tripled, whatever. They could no longer make the payments on them and defaulted on them. And then the banks had all these mortgages that were no longer operational because people were no longer making payments on their houses, which then resulted in banking failure. So the Austrian perspective would be the problem is the low interest rates, and the government here is creating a bubble and bursting the bubble, or the central bank in this case. They would also make the argument the same thing was going on here, and then this bursted the bubble that was the dot-com bubble. Going back even further, well, we can see during the 1970s period, we had the stock market going up and down drastically as the government was attempting to fight inflation, but it only seemed to fight inflation during off-election years. So we have a huge increase in interest rates here, economy goes into recession, election years coming up. You cut the Fed funds rate, try and stimulate the economy. After the election, you raise it again, lower it again, etc. And then this is the era of Paul Volcker that was willing to raise interest rates to the point that it finally got inflation under control. This is also the era of the Savings and Loan Fiasco. So the crisis of the Savings and Loan Fiasco was caused by duration mismatch, and again it was loans being issued at lower rates and then interest rates going up, but these were fixed rate mortgages, and therefore the destruction in the loan value fell on the banks, whereas initially the destruction in the loan value over here in the housing crisis fell on the individual mortgage holders. The real reason that banks keep failing all the time is they're not required to have any equity. Um, the Basel Accords set the Tier 1 and Tier 2 capital requirements, and they require banks to only have around 5-10% in equity to be able to operate. Of course, if individuals make deposits in a bank, they don't even worry about this because they have FDIC insurance. This creates a moral hazard system where the government guarantees the individual depositing against losses, and the banks really don't have to worry that much about losses because the government always bails them out, and the regulations associated with Basel don't really require them to have a whole lot of equity on hand. So one way of cutting down on banks going bankrupt all the time would be to say, if you're going to get FDIC insurance, you're going to need more than 10% equity, say 20% equity, 30% equity. Or in the extreme, you could just eliminate fractional reserve banking and turn everything into basically a money market fund for short-term loans or a bond fund for long-term loans, and just have the banks, just like mutual funds, Vanguard, etc., make money off fees rather than off borrowing short-term and deposit accounts and making long-term loans. Standard bond or mortgage valuations is the price of a bond is just the discounted sum of all future cash flows, and this equation by itself can be used to explain both the most recent housing crises and the savings and loan fiasco. In the case of the housing crisis, again, these were variable rate loans, so the interest rate increases fell on the individual borrowers. As interest rates went up, those individuals were not able to make their payments anymore, which means the banks did not receive the payment C, therefore the value of their mortgages went down as C went down from their mortgage portfolio. Whereas in the savings and loan fiasco, the individual mortgages were being paid, but the interest rate here went up. So interest rates go up, bond prices go down, and the value of the mortgages to the banks plummeted. So if we go back to the era of Paul Volcker, he drastically increased these interest rates, and again, P goes down. So here is a numerical example of the causing of the housing crisis. Let's say you got a $500,000 home loan during the relatively long low interest rate period, and you got this at 1%. So 1% per year divided by 12, you get this per month times 500,000. Then at least the interest component on your loan is only $416. The Fed raises interest rates up to 5%, this quadruples, and many people could obviously no longer make the payment on their variable rate home loan. Therefore, the C in the last equation goes down, and the bank's assets drop, and that wipes out their equity. Looking at more detail here during the time period of the savings and loan fiasco, we can see a graph here of both long-term interest rates and inflation from the 60s to around 2000. Well, most of the loans associated with the savings and loan fiasco were made back in this time period of relatively low interest rates. So if you were a bank and you made a 30-year home loan, down here we'll say at 4%, well, as inflation skyrocketed, long-term interest rates go up, and your 4% loan is going to be plummeting in value. Interest rates go up, bond prices go down. Beyond that, the passbook account rates would go up, so you would be borrowing money from your depositors at a higher interest rate than you were making off your loans. That at least would be the case if it wasn't for something called Regulation Q. Regulation Q was a government regulation that set the interest rates that banks and savings and loans made on their deposits. It was 5.5% for savings and loans, 5.25% for banks, and initially this locked depositors into the savings and loans and banks. But during this time period, a new financial technology was created, the money market fund, which allowed individuals to pool their money together and send it to somebody like Vanguard, who would then invest it in U.S. government T-bills, which were paying a pretty high rate of interest. So since the banks could not legally pay you more than 5.25% or 5.5% for the S&Ls, everybody started engaging in what's called disintermediation, and they pulled their money out of the savings and loans and they sent it to the money markets. And the savings loans, in desperation, did things like tried to give away plates to get people to keep their money in their accounts. So a lot of these things contributed to the savings and loan fiasco. If we look particularly at the inflation during this time period, well, we had inflation going up with money printing. Obviously, the government was not charging enough in taxes to pay for Lyndon Baines Johnson's Great Society program or the Vietnam War, so money was printed, money was printed, money was printed. Inflation goes up. Nixon finally defaults in here on the gold standard. That's basically the result of Bretton Woods, of the French demanding gold. If you ever get a chance, go to New York City, and you can go to the Federal Reserve Bank there, take an elevator down to the bedrock beneath New York, and there are jail cells full of gold. Some of the gold belonged to the French, Germans, British, Japanese, etc. And under Bretton Woods, all of these different entities, if they wanted to, the countries could bring in US dollars and demand gold, and then gold was supposed to be moved from jail cell to jail cell, in this case, the American to the French, and the French kept demanding gold for dollars, and Nixon finally said, we're defaulting, we don't have enough gold. So that was the default of the Bretton Woods Agreement here. About that time period, Nixon then put in price controls, which briefly lowered inflation, but also caused shortages. Most of those were repealed pretty quickly, except for the price control on oil, which was kept until the Reagan administration, which is why we had lines for gasoline in the late 70s. Clearly, these sort of measures didn't work, and inflation kept going up until Paul Volcker drastically increased interest rates in the late 70s, which then caused the savings and loan fiasco. So here is another way of looking at what was going on during this time period. We have a normal yield curve in which a bank or S&L can do well. They can borrow here at 5%, lend at 6 or 7, make money off of that transaction. But when Paul Volcker raised interest rates, they would be borrowing here at 15, and in this example, lending at 12. Obviously, you're going to lose money doing that. Plus, they had all these historical loans on the books at 5-7%, which plummeted in value. And this problem is very similar to what's going on right now and what caused, for example, the failure of Silicon Valley Bank last year. The reason that you had this inverted yield curve is that individuals investing in the market believed Paul Volcker. They believed he would get inflation under control, and therefore investing at 12% for 30 years was better than investing at 15% short term, because people that had the sense to buy these long-term bonds at 12% got basically a stock market rate of return from 1980 to 2010 without taking on stock market risk. My uncle was one of the people smart enough to buy a lot of these bonds. Today, things are a little bit different because the parts of the curve down here aren't necessarily purely controlled by the free market. We now have quantitative easing where the U.S. government also buys long-term debt and pushes down long-term interest rates, which makes it a lot more complex to analyze these sort of graphs from the perspective of what do investors in the bond market think. Here is another graph showing in more detail the causes of the savings and loan fiasco. Again, it was a duration mismatch problem. If we look here at the blue, red, and green graphs, the green graph is the equity in a bank, the red line is the assets of the bank, and the blue line is the liabilities. So if I consider a savings and loan, well, the assets of the savings and loan in red here are long-term home mortgages. As interest rates go up, bond prices go down, and the value of those mortgages plummeted. The liabilities are the passbook accounts. You could have $100,000 in a passbook account at 5.5% interest. But staying at 5.5% interest, if interest rates were allowed to go up, its variable rate, the principal is going to stay the same, and therefore the amount of liabilities associated with the bank stays the same, except for you add some interest. Whereas the value of the assets, again, well, if they're 30-year fixed-rate bonds, interest rates go up, bond prices go down, they plummet. So assets stay the same, or assets go down in value, liabilities stay the same. As the assets go down, the value of the equity plummets, since equity is just assets minus liabilities. Silicon Valley Bank was caused by the same kind of thing that caused the Savings and Loan Fiasco. Therefore, it should have been obvious there was a problem here, and Silicon Valley Bank managers should have had the sense not to do it. This shows actually how useless, in most cases, stock market analysts are. They tend to be herd behavior, and they tend to be a lagging indicator. So if we look right before the run on Silicon Valley Bank, we have JP Morgan, Piper Sandler, and Wedbush all giving overweight by our neutral recommendations on the bank. JP Morgan said everything's great. And then that was one day before the run on the bank, and then the day after, everybody downgrades. So again, you have to do your own research if you're going to, I guess, be successful in fundamental trading on things like this, because even people like Morgan, who have an entire staff that's supposed to be looking at the banking sector, don't seem to be very good at analyzing bank stocks. We can compare Silicon Valley Bank with JP Morgan. These are standard ratios for both of them. As with all banks, neither one of them has hardly any equity. We have equity to assets ratio of 8% here, and that is for JP Morgan. And for Silicon Valley Bank, it's also 8%. Debt to EBITDA, not that much difference. Return on equity, 13%, a little bit better for Morgan than it was for Silicon Valley Bank. Return on assets, a little bit better for Morgan than Silicon Valley Bank. But basically, they look the same, with one exception. There wasn't much cash on hand at Silicon Valley Bank, which is one of the things that got them in trouble. So the cash to debt ratio was much higher for Morgan than SVB. SVB, just like Morgan, didn't have hardly any equity. Banks aren't required to. So here we look at the capital adequacy tier 1 ratio in blue, around 15. Tier total capital ratio also about 15. And capital adequacy tier leverage ratio here around 8. So not much equity. Banks aren't required to have much equity. The combination of a lack of equity and a lot of large deposits is what caused the failure of Silicon Valley Bank. So on this graph, we have unrealized losses as a percent of CET1 capital. So unrealized losses would be interest rates go up, bond prices go down. Banks are allowed to hold on their books two different types of assets: those that they are marketing to market, which means if interest rates go up, they have to mark down the asset value, and then those that are held to maturity, in which case they don't have to write down the asset value. So the unrealized losses would be the assets they have not written down the asset value. So over here we have Silicon Valley Bank with a lot of unrealized losses. They invested a lot of money in 30-year government debt. Why did this end up being a problem? Due to a run on the bank. Well, they also had a lot of deposits greater than $250,000, which is the FDIC insurance ratio. So people realized, or the FDIC insurance limit, that in the case of bank losses, if they had more than $250,000, then they might lose their money and not get FDIC guaranteed. So these people went to Silicon Valley Bank and demanded their deposits back, and then Silicon Valley Bank was forced to remove assets from its held to maturity account and move them into its available for sale account and sell them to cover these runs. That resulted in them realize a bunch of these losses, and then the value of their assets plummeted, and they were no longer in compliance with the Tier 1 and Tier 2 capital requirements, and they had to be shut down. This could have been determined at least a couple of weeks before the bank failure by just looking at the 10K Edgar report from Silicon Valley Bank. If we look here at their assets, well, they very responsibly listed right here the held to maturity securities, the ones they don't have to market, at amortized cost and net of allowance for credit losses of $6 and $7 with a fair value here of $76,000 in 22 and $97,000 in 21. So we see in 21, there's not much difference between the listed value here and the market-to-market value here of 97, but as interest rates went up in 2002, then the listed value is 91, whereas the market-to-market value is 76, so that is around 15 billion in unrealized losses. And of course, they don't have to market because it's held to maturity. But with the run on the bank, they did have to start selling these assets to meet the demands of their customers withdrawing their accounts. And the difference between this and this of $15 billion was just enough to wipe out almost all of their equity. So they only had $16 billion in equity, $15 billion in realized losses due to the run. They're almost bankrupt, and they certainly don't have enough equity on hand to meet the Tier 1 and Tier 2 capital requirements. Therefore, they had to be shut down. As with past banking crises, the most recent run at Silicon Valley Bank has resulted in the government bailing out the banks. One of the programs to do this was the Bank Term Funding Program, which has been allowed to expire and only operated for a year. The Bank Term Funding Program allowed the banks that were having problems due to interest rates going up and the value of their portfolios going down to get loans from this Federal Reserve, and these loans were based on their assets being valued at par. This was allowed to expire. Things seem to have gone relatively back to normal, but at the moment there are still a lot of banks with a lot of unrealized losses on their books. The only way of getting rid of these losses would be if interest rates went back down drastically, which doesn't seem to be likely in the near future. So, while this has not turned into yet another full-blown banking crisis yet, that possibility still does remain. If you would like further reading on these different topics, I have articles on why do banks keep going bankrupt with the Foundation for Economic Education, a history of banking failures, basically banking failures in the 20th century, written up in the American Institute for Economic Research, and multiple finance YouTube videos, including those that further explore the concepts of duration mismatch and how this contributed to the Savings and Loan Fiasco. I thank you for watching this video.